account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened,
to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots, over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top three. In amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil's going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And that whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world. And when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
Planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology
could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1000 kmh hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. Its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. Every other form of fossil fuel hydrogen, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
Hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we're just doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. Blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality, and he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you when you speak to governments, when you speak to officials? Are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle.
Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
the first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's like really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space like really affordable and accessible for everybody, so that you can have fishing buddies go into space someday. But the first is special. And so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
This is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities. It doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls. You step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. Because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had like less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan, and his crew, Heron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name is Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over.
That's cool.
Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. they've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. I'd be like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
As a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice.
Glad we got out of the smoke.
Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky,
Look at it.
strip malls of the Central Valley.
We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. And we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of
California, very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts.
Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots.
On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think, like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command.
So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines.
And have you just sold them in the Central Valley or like throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019?
Yeah, so we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer, so vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S.
Connection
office is
lost.
here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LQ.
Can I take her out for a spin?
Please.
LEQ, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LEQ?
Yes?
Schedule a doctor's appointment.
No problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the U.S.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard, no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousey things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97, and he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water, at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence, robots, will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, just the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support. crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right?
You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and, of course, on Bloomberg Originals. It is kind of a Friday. It's our Thursday, April 6, 2023. Carol Masser, as you know, Tim is on leave. With us once again, Bloomberg Quick Take correspondent, chief correspondent, king of all things, queen of all things.
Just correspondent for now. We'll see, Carol, in the years to come.
We will indeed. Of course, Madison Mills is with us on this Thursday. We're getting ready to wrap up the equity trade today. It's a holiday shortened trading week. Bond market, you know, though, open tomorrow in an abbreviated session. We're going to have more on today's trade. It does seem like one that Maddie is afraid to kind of commit ahead of that monthly jobs report. So we're going to talk about both in the next 3 hours and, of course, on our simulcast coming up, countdown to the close.
Yeah, but speaking of the jobs market, 10 companies to watch, big names.
I love this. I love this. We're not going to give them away because there's a couple actually on the list, excuse me, that you're going to be like, what? How did this get on
And
the
then
list?
we'll tell you how they got on there. I mean, it's a great story.
I love when Bloomberg Business Week does this. Plus, we're going to talk about Apple's cash hoard, what to do with it. And speaking of what to do, what you maybe want to do with your money, your life in our brave, new, and wild world. I mean, in a world where mortgage rates are going up, we're not quite sure, put our cash under the mattress or what. Amex is a new card. Should we go for it?
Do you have a kid? I mean, it's more expensive than I love this story because, I mean, I just want to outsource all of these big life questions, and whatever Claire tells me to do, I'm just going with it. No questions asked.
This is what Business Week does so well. Takes kind of the big macro and then whittles it down and gives you some advice on what to do. We've also got a PhD in drone navigation. She's a guest. What happens when you get that? Well, you actually create a climate tech company. We're going to talk with the founder and CEO of Regrow. Fascinating when it comes to disruption innovation in the ag sector.
Such an important story, and I am so excited that we get to have her on today.
She's a new economy catalyst, and we'll get to her in just a moment. Right now, let's head over to our TV colleagues, Romaine and Vani. Countdown to the close starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left here in the trading session. Romaine Bostick alongside Bonnie Quinn. We're now joined by our colleagues Carol Masser and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. This is the final trading day of the week, at least for the equity markets, Carol Masser. So please be excited and tell us what's going on.
I'm always excited when I'm here at Bloomberg and I get to talk about the markets with you folks, indeed.
I love it when you pander.
I've had lots of years of training. Having said that, we do have the bond market open tomorrow, so it is about the monthly jobs report. We were talking about that this is a trade that just doesn't quite want to commit ahead of that monthly jobs report.
Yeah.
Having said that, you know where investors continue to commit, Romaine?
Where?
To AI stocks.
AI? That's still a thing?
It's still a thing, and it's going to be more of a thing. Check this out. We're going to bring up some names for you. Alibaba, you've got that up about 4%. You've got Alphabet up almost 4%. What's going on? You got a report that Alibaba was planning to launch its own version of ChatGPT-like AI tool this month. You've got Alphabet CEO talking to the Wall Street Journal saying it plans to add conversational AI features to its flagship search engine. And then you've got C3 AI. It is up 8%. Now, keep in mind, it's down about 40% in the past 2 days. But the company coming out, responding to those short seller claims. And then one more I'm going to throw out, Guard Force AI. It's a microcap, folks, but it is up 49% today.
Well, you're looking at tech, Carol. I'm all in on this jobs report tomorrow. Will we see yet another month where we beat estimates? If you look at this chart, you can see, and for our radio audience, over the last 11 months, payrolls beating estimates. So will that happen again? Will we see a full year of beats? It's important to note, though, the margin on those beats has come down, so that's encouraging. Also, given some of the soft data we've gotten this week, Romaine, ADP, ISM, will we see that softness reflected in that jobs number tomorrow morning?
Interesting. You talk about what the broader markets are doing, and we should point out, I mean, we're in a relatively tight trading range here for the S&P 500 on a weekly basis. For the day, we're up about 0.3% at that 4,100 mark. The Dow Jones Industrial Average unchanged right now, while the NASDAQ, that's your relative outperformer on the day, Vani, up about 0.7%.
Right, bucking a trend, a three-day trend. Let's have a look at the components of the S&P 500 that are higher and lower right now, because it is fascinating. The regional banks are getting a little bit of a bounce, but overall, they're really not going up anywhere. The KBW Bank Index is still down about 27%, so today's little bounce for them doesn't really mean all of that much. In fact, it's probably off the analyst reports, the analyst we were speaking to a little bit earlier, David George of Baird. If you look at the stocks that are trending lower, though, you've got things like fertilizer makers, agriculture stocks, trucking companies, all these stuff that moves around the economy, oil and gas equipment. We have very, very weak LNG prices today as well. The May contract is down about 7% right now.
One of the big gainers today, actually, believe it or not, in S&P 500 is Dish Network. No real news here, but something to keep an eye on here as we move closer to the closing bell. Those shares up about 4% here on the day. Costco, probably the most meaningful decliner, at least as far as its point contribution to the index, down about 3% after providing those March numbers that disappointed. And take a look at Levi Strauss. Actually came out with their report here, now having their worst day since they went public back in 2019. Shares down 16%. And Carol, you were just mentioning, of course, Alibaba. Those shares up about 4%. ADRs up about 4%. But let's go back to the job market, because Maddie, you were talking about, of course, the big jobs report tomorrow. We actually got the Challenger Gray and Christmas layoff numbers here, and I want you to take a look at those green bars on the far right of your screen for our telephone audience, for our television audience. That is the percent change in layoffs on a year-over-year basis, and it has been pretty dramatic, up about 300% from where we were last year. Now, on a month-to-month basis, it's only up about 15%, but the aggregate number, believe it or not, isn't that high. We're talking really less than 100,000 or so layoffs that we had in the month of March, and that's pretty much been the trend for the previous months as well. So while we have seen layoffs elevated, they haven't quite gotten to critical territory, at least not compared to past recession cycles.
Yeah, some great perspective, right, as we await tomorrow's monthly jobs report. Having said that, I feel like we keep getting little things from around the world and some big things that remind us that maybe things are slowing down. We got the IMF coming out warning that its 5-year global growth outlook, weakest since 1990. It was in a speech earlier today in Washington by IMF Managing Director Kristalina Georgieva. She spoke exclusively to our Tom Keene earlier on Bloomberg, and she talked about how specifically the IMF came up with that forecast.
What we're modeling is a period of slow growth that is being held back by a number of factors. One is not so dramatic. Some of the fast-growing economies like China or South Korea are growing fast no more. But you would expect that there would be others to pick up the torch of strong growth. And this is not happening.
That is, of course, the managing director of the IMF, Kristalina, Georgieva, forgive me, earlier
That's right.
with...
I think one of those is right.
It's Friday, kind
That's
of
all
ish.
right.
I know, it's okay. It's okay. Beat me up. It's fair. The forecast that they're talking about is 3% for the next 5 years, and they talk about higher interest rates biting. And so you do think about the impact. We talk about this on valuations when it comes to the equity markets. The impact that if we stay in a higher rate environment globally, what does that mean for so many different things when it comes to growth, valuations, and so much more?
And the one thing I thought that was interesting too, she talked about some of the big structural changes and this idea. I think the quote was something like we cannot support the global economy isn't able to support its weakest members, which I thought was an interesting comment coming out of a bank institution that is basically designed to support our weakest.
It's upsetting.
members.
Well, also, though, she talked about emerging markets, right? That we could see some strength, particularly in Asia, India, and China expected to account for half of global expansion. So I wonder what specific countries we can watch to look for some signs of growth this year.
Just on the inflation point there that Carol was making, Pakistan has a 21% interest rate right now. Sri Lanka is 16.5% in order to try and do something about their inflation. And really, what's the point? And this is why the IMF is having such trouble, because it's constantly trying to set boundaries, put down red lines, and these countries just can't meet them most of the time, Carol.
Well, I think what's interesting about that is it's just a reminder that inflation, right, Romaine, is a global problem, and you have global central banks working on it, and altogether, that's got to ultimately bring about a slowdown.
And well, it already has. I mean, most people will point to that, and I think you heard that, not just in the speech, but I think for those folks who have the terminal, really go back and look at Tom Keene's interview. I think she really explained it very succinctly.
Yeah, good stuff from the IMF managing director. All right, guys, we're going to be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We're going to count you down to the close on this Thursday. Yeah, Marie's right. Like, we're already seeing that slow down, and it'll be interesting to see when we get that monthly jobs report if it's like all of a sudden a surprise to the upside. That's a reminder that the labor market's still strong.
And that'll also just be interesting because equities are going to be off tomorrow. So I wonder, are the bond traders going to be able to get in ahead of the game while equities are taking the day off?
Yeah, and it'll be thin trading too, right? So that can complicate things or maybe exaggerate a trade. Yep. All right, so we talked about the IMF warning about global growth over the next 5 years. Weakest in more than 3 decades. We talked about Challenger Gray and Christmas survey. We had some Fed speak from Jim Bullard today and more. So let's tie it all together for you. Joining us is Bloomberg News Global Economics and Policy Editor Kathleen Hayes. She's here in our Bloomberg Interactive Broker studio. And also with us is Bloomberg News Economics Editor Molly Smith. Molly, I do want to start with you. You're on the phone here in New York City, but we just talked with our TV colleagues about some of the data points. When you take a look at the week that was when it comes to economic data, a lot on the labor market and elsewhere, what does it show us and tell us?
I think to me it looks like what I would think the Fed kind of wants to see here, that like finally we're getting some stronger indications that the economy is weakening. Saw that with the ISM gauges of manufacturing and services that both came in weaker than expected. And that the employment indices for both of them may be suggesting that hiring is slowing, but also because there's weaker demand, not necessarily because they're struggling to fill positions. And seeing with the JOLTS data that job openings came down significantly, and unemployment claims today was a bit more due to the data adjustment factor, but still brought the level of applications up more in line to what we'd expect given the amount of layoffs we've seen.
And Kathleen, looking at this from a global perspective and hearing that outlook from the IMF today saying like 90% of the globe is going to see a slowdown in the year to come, I mean, what is the global economy looking like and how bad is that slowdown going to be?
Well, it's not going to be any worse than they thought it would be in January. But, for the global economy, when you get to 3%, when you get to 2.5%.
But they didn't improve it.
They didn't improve it. And those are very slow numbers. Yeah. You don't compare it so much to your U.S. GDP, it's above 0, it's still okay. No, this is not a good level. What's fascinating to me about this is that the IMF Kristalina Georgieva. I always have a hard time
See,
with that
I'm not
name.
the only one.
No, it's hard.
Romaine, where are you? So you can just see.
Kristalina.
Even the great and powerful Oz of Kathleen Hayes.
Kristalina is the easy part.
I know.
But anyway, look, they keep supporting. They said, look, as long as inflation's high, central banks have to keep raising rates. They've been saying that for the last year. And so we know that the U.S. economy, according to our Bloomberg Economics, remember the latest shock survey they did, 97% chance recession starts in July of this year. The services PMI decelerated pretty quickly, but it's still growing. Anyway.
Do you agree that the data says things are slowing down?
It's still mixed. That's why the jobs report is so important tomorrow. It's Friday, right? Tomorrow? Good Friday,
yeah.
As a matter of fact.
And we're trying to keep track.
There we are. But because that's the nut that has to crack. And that's what the Fed has been saying. Tight labor market means you've got strong final demand. Strong final demand keeps pushing up people to buy things, pushes up prices.
Right.
And that's what has to happen. They said, well, we don't have to have a recession. We don't have to have unemployment go up a lot, but we just have to get that less hot so wage increases aren't as much and these aren't expectations of prices continuing to move higher.
Molly, do the data points that we're seeing specifically on jobs, like it's hard in terms of timing, like tomorrow's monthly jobs report is backwards looking, and I'm looking for kind of forward-looking indicators. Are we seeing any of that shows that the labor market is starting to come down more significantly? You talked about JOLTS.
Yeah, and I mean, JOLTS is even more backward looking. That's back in February, which seems like ancient times.
No, fair, right? Yeah.
Yeah, it's tough. I mean, we did see something else today about layoff announcements in March, which I guess was not all that long ago, and then those were up pretty significantly, and that this was the highest first quarter total for layoffs since 2020.
Is all the data though, Molly, but before the bank collapses?
Good question.
What's that? Sorry,
is all the labor data in particular? All the labor data in particular before the bank collapses?
It's a little mixed. Some of these, they have different survey periods, and it can vary month to month. So we may get a little bit of that, but it's I don't know how much that would really show up in tomorrow's jobs report, if at all.
Right.
But on that, though, I have to wonder about whether or not the Fed cares about the impact of something like the banking crisis. Laura Mester said earlier this week that, they're looking at regional banks and they were already tightening pre-banking crisis. I wonder to what extent, Kathleen, if you want to weigh on this.
Sure, they care. They care a lot. I mean, look, SVB going down has been very bad for the Federal Reserve and other regulators. I think this raises questions about how well they're doing on that front. Congress maybe needs to change some rules, and then it help lead to Credit Suisse. This is not a good position for them to be in.
But it has, in an absurd kind of way, kind of dragged in slow down maybe lending that's going on. Certainly tighten the financial market. Like it's kind of almost to some ways, right? Help the Fed a little bit in their job.
Probably, and I think right now they really do truly believe that this is stabilized. Everybody's kind of
feels that way.
They've got all the right things going now, and so that's why it's not that they don't care, but they can put it to one side and say we still need to fight inflation. And look, they're not talking about that much more. Even one of the most hawkish, Jim Bullard, St. Louis Fed, is looking for a 5.6% ending point now, and they're probably not going to do like a 75 and a 25. They've kind of realized that maybe 75 is enough, more than enough now. 50 maybe you don't need, but I think it's a delicate balancing act.
And they're going to probably stay high for a while. Well,
oh yeah,
relatively speaking.
I'd be surprised. No matter what they have or said, they're not going to even think about cutting before the end of the year.
Like a long pause period before a pivot.
Yes,
is what you're anticipating. Molly, I want to bring you in here on some of the Bullard commentary that Kathleen and Carol were mentioning. I just wonder, is there a sense at all from non-voters of like a shush, you're messing things up for us?
That's funny. I think with Bullard in particular, we know he's one of the more outspoken hawks of the committee, whether he's voting or not. So I'm not really surprised to hear him talk down the credit crunch and say we've got to keep fighting inflation. But at the same time, other members of the committee who are not as outwardly hawkish as he is have been conveying the same message. So I don't find that really surprising. The one other thing, though, I did find interesting this week, I'm not sure if we've mentioned this at all yet, was a Dallas Fed report showing the weakest demand for loans.
I talked about it earlier in the week.
Yeah, since 2020. So, I mean, if they are looking for evidence that the banking crisis is starting to have some effects in the economy, that would be a pretty good place to start.
I feel like loan demand is such a smart thing to watch. I feel like in this cycle. Kathleen, you're going to be moderating a panel at the World Bank next week, and talk to us a little bit about who's going to be there briefly and just kind of what you want to get from them.
Well, actually, when you go to these meetings, World Bank, IMF, there's a lot going on besides just the forecasts and things like that for the economy, a lot. So this is governing effectively during challenging times. It's going to include the Deputy Minister of Finance for Ukraine. They've had a challenging times, trying maintaining a functioning government then. The Minister of Finance for Zambia, that's the poster child for debt restructuring. They had a corruption and all kinds of things in the previous administration. They're trying to deal with that. China's dragging their feet. But I think, and Red Cross and a couple other agencies like that, how do you do it? What has to be done? Who needs to come in and help? And and I think it's the positive aspect is people are doing it. What do others need to do? And it's going to be streaming live Wednesday, 10 o'clock in the morning, if anybody wants to get on their website and watch.
No, great perspectives. And speaking of perspectives, Molly, what starts next week is earnings here in the United States, which I love. The big banks obviously in focus. We're going to talk a little bit later on about Delta earnings and give you a little bit of a preview for next week. But how do you think about, as you track the economy here in the United States and watching the economic data points and the Fed speak, but also thinking about what we're going to start getting from the C-suite?
I mean, when you said next week, my mind went to CPI.
Mine too, Molly.
Maybe I'm just too much in the weeds of the economy data, but that one's definitely going to be really important for the Fed as we're just looking at,
But it's not even the Fed's preferred inflation gauge, I thought.
Oh, but it's still pretty important, right, Molly?
It's so out there. You can't ignore it. It's, this is the one when people say inflation's running at 6-something%. I mean, that's CPI. So this is the one that's really just so much more out there. And I think.
But where were we a year ago? Where were we a year ago, Molly, on CPI?
Where were we a year ago on CPI?
Was it like 8-9%?
I mean, approaching 9.
Like yeah.
But Carol, what are you looking for? Because I think you're right. We want to get the narrative from these companies, right? What are they seeing for consumers? What are they seeing in terms of prices, right?
Right. Are consumers not spending? We got some numbers from
Costco.
Right?
Yeah. I mean, the Costco story tells us that maybe that middle upper income consumer is struggling, which feels like a really important metric.
Absolutely worrisome. And then are companies spending, whether it's IT and so on? Are they doing layoffs? What are they doing? Are they preserving cash?
Banks. The banks. They're going to be huger than ever this year, don't you think? Anything they say, anything they release.
All right, so Molly, I'll give you the CPI report, but I'm going to keep the
We'll be there with you,
Molly. All right, guys,
Thank
have a really good weekend. Really appreciate this setup with us. Kathleen Hayes, Global Economics and Policy Editor at Bloomberg News, as we mentioned, that panel at the World Bank next week, so check it out online. Kathleen here in studio. Molly Smith out there on the phone in New York City. She is Economics Editor at Bloomberg News. Catch all of her reporting and her team's reporting when it comes to all of the economic data points. Maddie and I just getting started on this Thursday. Carol Master and Madison Mills, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We check markets all day long here at Bloomberg. Tech giants are leading today's stock gains ahead of that key jobs print tomorrow morning. 8:30 a.m., of course, when the number drops, but Bloomberg will have special coverage. We got a special edition of Bloomberg Surveillance beginning at 7 a.m. Eastern. Yes, live coverage of tomorrow morning's jobs report right here on Bloomberg Radio. Here's where we stand. We've got the S&P higher, up by 0.2% right now. That is a gain of 0.9%. The Dow in the red, been a choppy session for the Dow. It is down now by 32 points, a drop there of 0.1%. NASDAQ Composite Index up 80 points for NASDAQ. That is a gain right now of just about 0.8%. 10-year yield 3.29%, but the 2-year that's yielding 3.82%. Spot gold down 0.6%, 2007 the ounce. West Texas Intermediate crude, we'll call that little change, down 3 cents, 80.58 a barrel. As for the interest rate outlook, Cameron Dawson is Chief Investment Officer at New Edge Wealth.
Equities are starting to wake up to the fact that usually when you see pricing for a lot of Fed rate cuts and lower yields and a re-steepening of the yield curve after an inversion, it means that there actually is economic and earnings risk on the horizon.
Boeing shares are higher by about 0.2%. Sources tell Bloomberg Boeing plans to crank up output of its 737 family of jets to a 38-plane monthly rate by the middle of the year, months earlier than analysts had predicted. Recapping stocks mixed, S&P up 8, a gain of 0.2, 10-year yield 3.29%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, and yes, that trade on some pretty light volume here. All right, Charlie Pellet, thank you so much. Well, as you know, we've been talking about it, Maddie and myself, with the team. Big week with multiple data points on the U.S. workforce. Of course, tomorrow we get that monthly read on the U.S. Labor Department. And, you know, we kind of went over all of the numbers, and we know that there are some weaker points, certainly with the U.S. labor market, but time will tell ultimately if we continue to slow down.
Yeah, and we've got a great guest on some thoughts on the jobs market. Sinem Buber, lead economist at ZipRecruiter, on Zoom with us from New York City. Sinem, great to speak with you, and we're excited to get your take on all of the data coming in and what we can expect heading into tomorrow. We just talked with our in-house economy experts. One was mixed on the outlook for jobs. The other said we're definitely going to see softening. Tell me where you stand on this. What are we going to see tomorrow?
Softening it is. Softening it is. When we're looking at the ZipRecruiter marketplace data, what we're seeing on the job posting side is a big normalization going towards, the trends are pointing towards what the numbers that we have seen in, before the pandemic, Feb 2020. And that's across majority of industries, except for 3. We're seeing still strength in healthcare, personal care, and travel. And we can see it from the, business activities and other, private data from TSA passengers and all of that. So those are the industries that we're going to see strength tomorrow. But for the rest of the industries, we are expecting to see a big slowdown. And if you ask me that question, at 8 a.m. this morning, I would say we would see a number around 250,000 new jobs for this month. But given the unemployment insurance claims ticked upwards and revised, the last week is also revised significantly, I would say we're going to see a slower, around 200,000 new jobs tomorrow, with a little bit increase in the unemployment side.
Right now, the Bloomberg survey, change in non-farm payrolls, 230,000 for the month of March, and the unemployment rate at 3.6%. But it is slowing down. And is that the important thing as we think about the challenges to the Fed in slowing things down, that the trend lines are in the right direction? Not great if you're losing a job, but the right direction for what the Fed needs to do.
Absolutely. But I think what is more important, because all of us are paying attention to the top number, and it is very important to understand the strength of the entire economy. But the transmission channel between the labor market and the inflation side, what Fed has its eyes on is the wage growth. So even if we're going to have a strong number tomorrow, coming with a deceleration in the wage growth, that's still good news for the Federal Reserve, because they want to see that wage growth slow down. They want to see more labor coming into the workforce, labor rate picking up and demand for labor normalizing. So the pressure on the wage growth is going to go off. So as long as we see the wage growth around 0.2 month over month, which is, significantly lower than what we have seen for the last 1 year, this is still good news for the Federal Reserve.
Sinem, say that number again because it got caught in kind of a technical
0.2, 0.3. I think the consensus is about 0.3 right now. Last month it was 0.2% month over month. So anywhere, anything below 0.4 is a good number in terms of the monthly wage growth.
What are you seeing when it comes to wages at ZipRecruiter? Where are you seeing strength?
Well, right now, the strength is still in the industries that are, facing the labor shortages. One of them is leisure and hospitality. But even within the industries where we had seen double-digit, wage growth for non-supervisory positions, where they had the biggest challenges when it comes to filling up the positions, even within those occupations, we are seeing a softening in the wage growth right now. And that's because of two reasons. First, the employers are being really conservative with, filling up these positions right now. They want to wait and see, if there is a potential recession, if they're just going to lay off these people in the future, 6 months down the road, they don't want to close those deals right now. And the second one is we're seeing more people coming back to the workforce. And it's because of the, CPI, the cost of living is really high right now. They're not able to survive on unemployment insurance or severance packages that they're getting. So more people are getting back to the workforce. And those are the two things that are putting the wages down right now.
Are companies continuing to hoard workers?
Well, the employee hoarding was really about the tech industry. I don't think we can generalize that term for any kind of industry that's outside the tech. That's what happened during the peak times in 2021 and 2022 within the tech industry. Apart from the tech, I would be really cautious to use that term for the other industries. However, overall, when we look at all the employers across all industries, they are being more conservative with their hiring plans in the future.
Speaking of tech, so sorry, go ahead. I didn't want to interrupt you.
Yeah, industry aside, I know all of us are paying so much attention to the industry side. What I'm going to watch is the small business segment right now. I think there's a big renormalization going on with small businesses, and they are going to be disproportionately affected from the credit crunch that we're going to have because of the financial instability as well.
Well, that's really interesting. I was going to stick to tech and layoffs, but what's your thought, Carol?
What I am curious is, you are an employment site, and there's postings, you're talking to companies. I mean, so how much has business changed, I don't know, since the bank collapse? I'm just curious, what are the things that are really impacting either companies putting postings out there or, individuals looking for jobs? Like, what is it that you think out there in the macro that's really impacting what's going on in the labor force right now?
So what we're picking up from the traffic that we see on the site is the job seeker, job search traffic is picking up significantly right now.
What significantly? Is it up 100% or what's that,
No, it's much higher. It's much higher. It's not 100%. It's higher than the last 6 months, but it's not 100% increase. What we're seeing is more people are either laid off or they're afraid that they will be laid off. So what they're telling us is that they're getting more aggressive with their job search, and even if they land a new job, keep searching for a new job. That's about 70% of the job seekers told us in our recent survey that they will still search for a job even if they get a good one, themselves against a potential recession layoff. So the job seeker activity is definitely picking up. We're seeing more people coming to the site. We're seeing more people being more aggressive with their job search right now.
So more people are looking for jobs, but less people are quitting. Can you help me square those two?
Well, the quits are still about 4 million in a month, and that's much significant than what we had seen before the pandemic. So compared to the peak time of the Great Recession, where we had seen 4.4 million people quitting, 4 seems like a lower side, but compared to the pre-pandemic level, that is still very high. So the quits remain high. And the reason for that one is generally, the dilemma is the wage growth is what drives the quit rate so high. When people feel like they're going to get a better paycheck, when they switch their jobs, they are more motivated to look for outside, opportunities. Right now, what is happening is the wage growth is decelerating, but the job seekers are feeling like there are still options out there, and they might find a job that provides a better job security, a more stable job that they won't face a layoff for the next 6 months or 1 year if there will be a recession.
How bad do you think it potentially could get? Do you have any indications? I mean, I know none of us have that crystal ball, but I'm just curious, as someone who understands this space, has been doing it for a while, can you tell with what's happening now, what you're hearing from maybe the corporate clientele that use your site, what might be to come later on this year? Does it smell of or speak of recession?
Well, this is really the toughest question. I don't think anyone has a 100% sure answer for that one. However, the next couple of months will set the tone. If we are to see a strong jobs number tomorrow with a deceleration in the wage growth, so the wage growth is moving in the right direction. And if we are to see the CPI super core that's going to come out next week, CPI core inflation slowing down, then there is no point for the Federal Reserve to go more aggressive with their rate hikes. Then we are talking about the soft landing. There's still the soft landing still might be on the table. However, if the wage is going to accelerate further tomorrow, and if we're going to see the super core inflation, that's what the Fed focuses on, is accelerating, still trending up, then they are likely to go with more rate hikes. And that's what's going to jeopardize the likelihood of a soft landing. So I think it's still early to say. We still have a month to go before we're more sure. But yeah.
Yeah, that's the debate that we continue to say day to day, and certainly playing out in the financial markets to some extent, especially on the equity side of things. Sidam Buber, thank you so much. Lead economist at ZipRecruiter, joining us via Zoom in New York City. Just a reminder, non-farm payrolls, we are looking for 230,000 for the month of March. That survey coming out at 8:30 a.m. Wall Street time tomorrow. You are listening and watching Bloomberg Radio. All right, let's get a check on the latest world and national news. We head to Nancy Lyons. She's in our 99.1 newsroom in the nation's capital. Hey, Nance.
Thanks, Carol. Lawmakers in Tennessee are poised to vote this afternoon on the fate of 3 Democratic state lawmakers who are facing expulsion. It's because they participated in protests on gun reform following the recent school shooting in Nashville. The lawmakers are accused by some Republican lawmakers of breaking the rules of decorum by inviting the young protesters into the chamber. Democratic Representative Justin Jones justified his actions today before the vote.
We called for you all to ban assault weapons, and you respond with an assault on democracy.
Jones called on his Republican colleagues to reject the NRA and to stand up for the state's youth who are terrified by mass shootings. Some Republicans have called Representatives Jones, Gloria Johnson, and Justin Pearson insurrectionists. Supreme Court Justice Clarence Thomas may be facing a new ethical dilemma.
The news outlet ProPublica, citing documents and interviews, says Justice Thomas and his wife Ginny have gone on luxury vacations, private jet trips, and yacht excursions nearly every year for the last 2 decades, courtesy of Republican mega donor and Texas real estate magnate Harlan Crow. The report says Justice Thomas has failed to disclose those trips in financial papers. Legal ethics experts say that could violate a Watergate-era law for federal officials, including justices. Crow says he's paid hospitality to the Thomases, but they've never asked for his gifts. In Washington, I'm Nathan Hager, Bloomberg Radio.
Following release of that ethics report, Senate Judiciary Committee Chairman Dick Durbin says his panel will act. The Supreme Court today ruled a 12-year-old transgender girl in West Virginia can continue competing on her middle school girls' sports teams, while a lawsuit over a state ban continues. And at the Masters, the leaderboard, Victor Hovland is ahead at 7 under. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
3:40 on Wall Street. We've got 20 minutes to go ahead of the closing bell. We check markets all day long here at Bloomberg. The Dow lower, S&P, NASDAQ, they are both higher. Let's find out what's happening as we head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks mixed in quiet trade with the Dow currently down 39 points. S&Ps are higher by 11 and NASDAQ climbs by 90. The U.S. 10-year yield at 3.3%. Gold falls 13. Energy is little changed, and Bitcoin is lower by 0.4%. Of the main 11 S&P sectors, leaders were telecom and tech. Energy was under pressure, and leaders to the upside in the Dow, Microsoft and Walmart, while Caterpillar and American Express led to the downside. In other news, Jamie Dimon said the banking crisis has increased the odds of a recession. Boeing is poised for a 23% hike in the 737 jet production by mid-year, and Costco fell in the lowest U.S. sales growth in almost 3 years. Wrapping things up, Lumentum fell 10% on preliminary guidance. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, and to hear live breaking news over your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just under 18 minutes left in today's trading session, getting ready to wrap up, certainly the equity trading week, but as we've been reminding you, there is that monthly jobs report tomorrow, and we do have an abbreviated session when it comes to the bond market. Having said that, let's get to it with Abhay Deshpande, founder and chief investment officer at the registered investment advisor, Centerstone Investors, a global value investor for our loyal listeners and viewers who have heard him before. Abhay, great to have you back with Maddie and me. How are you?
Great. Doing very well. Thanks for having me back.
Well, good to have you here. I am curious about, when you look at today's environment, what indicators and trades are you paying the most attention to?
Well, I think I'm not any different, kind of wondering when's that next shoe going to drop as it comes to is a recession, is inflation going to fall off the cliff, or whatever. The bond markets are saying one thing, the actual CPI numbers are not falling. They're not playing nice, but you have plenty of indications now that the credit cycle is turning. It began turning even before this banking sort of fiasco in California. And even if that's not a contagious sort of 2008 sort of scenario, I think the knock-on effects are enough that credit availability will be tightening, even in the face of what looks like to be a weakening economy. So you have the everything in place for, as I think Jamie Dimon was talking about, potentially a recession or something, some sort of an accident coming soon.
Are you seeing those risks equally across the globe, or are you seeing spaces for safety and potential growth globally?
Yeah, the way I usually look at it is, kind of where were the excesses, right? And the excesses were kind of like, monetary policy, fiscal policy in the United States. You had some version of that kind of extreme response all over the world, but nothing like you had here. And you also had, quite housing went crazy, car sales went crazy, or at least prices of cars went crazy. And you don't see the extreme as much as you did in the United States. You don't see that as much overseas. And in addition, you have the U.S. was kind of first in and out of the lockdowns, followed by everybody else. Last being China. So there's some you can make a case that the rest of the world is kind of behind the cycle. In this case, that's a good thing.
Yeah.
And we continue to find outside of that, I'm not a macro guy. We're stock investors at Centerstone. we continue to find plenty of stuff to buy overseas. I mean, there's like the macro kind of thing has been a challenge, and it has been really for 20, 30 years. There's always something to be worried about. But here, we're finding quite a lot to do from a bottom-up perspective.
Well, Abe, let's get to it then. Let's talk about some of the names. You mentioned auto sales specifically. You like something or have been buying something, right? On the high end of auto, and we're talking about Porsche.
Yeah, Porsche. I mean, it's not, a typical auto company in the sense that it's kind of like a luxury product, like Ferrari.
Kind of like
and
a luxury product.
Feels pretty luxury.
I don't know. I don't have one, but I know people who do, and yeah, it's definitely a luxury product. But I mean, like comparable to Ferrari in the sense that the car is one thing. It's just all the add-ons they put on it, like 100% margins, add-ons that creates a profit margin that's just like kind of crazy for a car. Which suggests to me like the buyer is just different. You're starting to see pullbacks already in auto loans and loan availability and auto sales, but not so much in the luxury, ultra luxury space. In addition, that's a company that just came public a few months ago, and it trades at not a Ferrari. It's a relative value a case that we're making, not an absolute value case. It's just cheaper than what other luxury type products are trading in the markets.
And when you look at luxury companies specifically as we head into earnings season next week, if we see companies that have cut costs but missed out on earnings estimates, how likely are you to kind of forgive them given the cutting in costs?
I mean, it sort of depends on why they missed. Is it a product failure, a sales failure, customer service failure, or is it just the cycle? The cycle can surprise everybody. Like the demand can fall more rapidly. Now we don't have a huge amount of exposure to that type of situation. More typical is a company like Sodexo or an Air Liquide we own in the portfolio. Both, coincidentally, both are French, but they're more like pass-through vehicles. Costs go up, they just pass through the customer base. And I like that inflation protection. I like the ability it gives them to kind of survive any sort of economic environment. And the products they sell, whether it's facility services or air, components of air that Air Liquide distributes to the industry, those are not as cyclical, and they tend to be, kind of needed regardless of whether or not there's a recession. So I like those types of businesses. At Centerstone, we own a lot of that type of thing. So we're not so exposed to it, the down cycle in the economy.
Hey, two other names that our producer shared with us that you shared with him that you guys have been buying. Shimano, am I saying it right? The bicycle maker?
Bike parts, yeah.
Yeah. And then Ryanair. So what is it? And I only got about a minute left here. You can either pick one or just give us some thoughts on them.
Yeah, simple. Shimano. Anyone who rides bikes knows what that company is. There's only a couple of companies that make the parts on a bike. Typically, the part is the one that was what the derailleurs and the brake systems and all that. That's what has the value on a bike. So, and there's just a couple of them. Cycling has been gaining more and more popularity, especially with the younger generations, and and Shimano kind of rules the roost there. Ryanair is another example of a company that kind of dominates a niche, just like Shimano does, just like Air Liquide does, just like Sodexo does. They dominate a niche, which is low-cost air travel in Europe, and no one can touch their costs because of the way they built the business. And so you have they're sort of cyclical, obviously. Yeah. Shimano, literally cyclical, quote unquote. It's my joke for the day. But for the most part, they occupy areas that are growing over time.
Right.
Not maybe smoothly, but they are growing over time. I like that. They're all cheap.
All right, and I'm looking at the ADRs that trade here in the United States, just up about 12%. Abe, good to get some time with you. Abe Deshpande, founder and chief investment officer at the RIA Centerstone Investors, joining us via Zoom here in New York City. All right, folks, we've got just about 10 minutes left in today's trading session. Like we said, it looks like a trade not willing to really have some conviction in this market. A bit of a mixed trade here, but we're definitely off our worst levels on the equity side of things.
And a lot of low volume because it's a short week.
That's a good point. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
It is 3:53 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pella. We've got Boeing shares up now by 0.5%. Sources tell Bloomberg that Boeing plans to crank up output of its 737 family of jets to a 38-plane monthly rate by the middle of the year, months earlier than analysts were expecting. Speeding up manufacturing and deliveries of the 737 MAX could allow Boeing to reach its target of $10 billion in yearly free cash flow by 2025 or 2026 without giving up market share to rival Airbus. Levi Strauss shares are plunging now by 16% after it took a charge in the most recent quarter. And with more, here's Bloomberg's John Tucker.
Charlie, it's part of a restructuring program that is expected to continue through this year. Levi recognized a net restructuring charge of $11.4 million, primarily tied to job cut-related severance benefits. The plan is designed to reduce costs and streamline operations. The retailer also reported first-quarter gross margins of 55.8%, below the 59.3% reported a year ago, and less than the average analyst estimate. Quarterly revenue, meanwhile, exceeded expectations, suggesting that demand for denim held up in the first part of the year, even as overall consumer spending cooled. Charlie?
And that's John Tucker reporting. Looks like a food fight is over. Sweetgreen has renamed its latest offering in a tentative deal to avoid further legal action from Chipotle Mexican Grill. And those are some of the top company stories we're following. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, just under 4.5 minutes left in today's trading session. We've got equities, as Charlie mentioned, way off their lows of this session, but tight range in terms of trading, and just keeping a watch on yields. That 2-year moved up today, 382, but we'll see whether or not tomorrow's jobs report changes all of that. Speaking of tomorrow's jobs report, we did want to bring to your attention a story that's on the Bloomberg. Has to do with what's going on with some of the big tech companies and the big tech names here in the United States, and how they are having a tough time, Maddie, when it comes to laying off workers over in Europe.
Yeah, this is such an interesting story. Labor laws are making it hard for some of these big tech companies to lay off and reduce their headcount in Europe. In the U.S., those companies can announce widespread job cuts, let go of hundreds, if not thousands of workers within months, and we've seen that happening. But in Europe, there's just so much labor protection and regulation around it that they're getting a little bit of a pushback struggle when it comes to going through with those layoffs in Europe.
Yeah, it says, like Google, they say in this story, currently in negotiations with works councils, because, in France and Germany, the labor laws, as you said, among the strongest in the EU. It's a very different labor environment than it is in the United States, because in the U.S., right, you can announce job cuts and you can let go of workers, many workers, very quickly.
And there
are some rules and some specifics in terms of how you do it, but it can happen pretty fast.
Of course, that is
Having
so
been
true.
in a layoff long time ago.
No, same. I mean, like, who among us? I feel like once you get your first layoff done, especially in media, you can like rest easy knowing you got your first one
broken
done.
in, right?
Yeah. Yeah, exactly. But I have to wonder whether or not this is going to cause an impact on headcount in the U.S. Do companies think that way? Are they?
I don't know.
Do that?
That's a really good point. Whether it's just about getting total head count down, but if they've got responsibilities and things that need to be done in certain countries, can they? I don't know. That's a really smart question.
Or can you just shut down an entire, like the Dublin office they talk about in this story? Can you just shut that office down? I don't know.
I know, right? So stay tuned, right, to see how these numbers ultimately played out. Because I remember when they announced the numbers too, we're like, well, just keep in mind there's some overseas, but if they can't cut them there, as you said, does it impact what's going on here in the U.S.? All right, we'll know more certainly about the labor picture. We got data points throughout the week, but of course we get that monthly jobs number, 8:30 a.m. Wall Street time tomorrow. All right, just a few minutes left in the trading session. Let's head over to our TV colleagues, Vani and Romaine, because Bloomberg's Beyond the Bell starts right now.
This time, we're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Bonnie Quinn, we're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Relatively tepid price action, Carol Masser, low volume here on this Thursday afternoon ahead of a big jobs report on Friday morning.
Yeah, I thought it was really smart earlier when you said, really a tight range. It just shows that investors not really looking to commit in either direction here. Having said that, looking for some outperformance, as I like to do. Those names, those Chinese names that trade in the U.S., we talked about Alibaba earlier in terms of their AI initiatives, as well as Google, but the NASDAQ Golden Dragon China Index up about 1.5%. Keep in mind some economic data overnight from China. Their services activity surging to more than 2-year high, and we know that Chinese economy is so important.
Of course, but we also got to look at treasuries, right? Because it's the 5th day in a row that the 2-year yield has come down, the longest stretch since July of 2022. I believe it's a 49 basis point swing on the 2-year this week alone. So while we're not seeing a lot of action on the equity side, it feels like the bond market, as always, in the past couple of weeks and months, a lot going on over there, Vani.
Absolutely. Like I say, we've had this major swing from the 2-year out to the 10-year. Not so much, though, at the very, very front end of the curve. Those 3-month T-bills haven't gone down, but they also haven't risen. And many economists say that, you need to see those rise before you actually start a recession. There is the big roar.
All right, as we come to a close here on this Thursday afternoon, remember equity markets, the cash markets will be closed on Friday. So this is the final day of the trading week here. You're hearing the clapping and the cheering. The Dow Jones Industrial Average relatively unchanged on the day. It takes a while for these numbers to settle, but not much of a gain here on the day. The S&P 500 is going to finish decidedly in the green, up about 0.3%, or roughly about 15 points here on the day. We should point out on a weekly basis, this is actually the tightest trading range that we've seen from peak to trough for the S&P 500 going back to at least November of 2021. The NASDAQ composite did see a little bit wider range, and it's going to close higher by 91 points or 0.8%. And Carol Masser, the Russell 2000, going to finish the day higher by about 0.1%.
All right, taking a look at the S&P 500, as you said, tight range, low volume. But if I look at the S&P 500, as we start to get into some of the specifics on the trade here, you've got kind of an even split here, Vonnie. 265 names to the upside, 235 to the downside. If I look at some of the top performers in the S&P 500 in the past 4 days, you got energy names and healthcare. That's kind of a feel of what the trade was like this week.
Exactly, and that continued today, Carol. It seemed like a market without all that much conviction, just the conviction that it didn't want to go that much lower, wanted to stay above 4,100, which it did, 4,104, practically 4,105. You mentioned some of those names. We did have utilities higher up by 0.7% as a group. The transportation index up 0.9%. Media and entertainment up 2.2%. But most of the upside was really thanks to the mega tech names like Alphabet. And then some of the banks. First Republic was one of the top movers as well, up 4.3%. You mentioned the energy companies to the downside. The energy index, in fact, was the worst performer, down 1.5%, followed by telecom services, down 1%. And then things like materials and autos as well.
All right, so let's get to it. Some of those individual names I talked about, I think Google earlier. Google ending the day with almost a 4% gain, up 3.8% to be exact in the Thursday trade. Top of the NASDAQ 100, top in the S&P 500. Not sure that there was really a specific catalyst, although you did have the company's CEO, Sundar Pichai, talking to the Wall Street Journal, talking about AI intelligence features into its flagship search engine. So everybody is agog, if you will, when it comes to AI. Alibaba,
Not me, Carol Masser.
I will get you there. Alibaba also up more than 4% in today's session. We talked about this as well. It's planning to launch its own version of ChatGPT-like AI tool this month. And then AMC Entertainment, up almost 21% in today's session. There's a lot going on between its preferred shares and also its common shares, a court ruling, the company continuing to evaluate next steps. There's a lot going on in the specifics. I'm not going to get into it, but it is important in terms of the trade because there's a distinction. The common trade higher, the common stock, I should say, the preferred lower, and they've been looking to kind of close that, combine that, but a court ruling saying differently. But nonetheless, the common shares up almost 21% today.
Well, I know we've been talking about it all day, but I have to continue to look at Costco here in my decliners, down just over 2% on the close. To me, the big question here is the health of the American consumer, right? This is a company that traditionally we've seen middle to upper income individuals at Costco. Does this indicate anything about us potentially heading toward what some of our guests have been calling a rich recession, seeing that the economic slowdown is going to be impacting those higher income earners moving forward? And sticking with the consumer story, Levi's, we've been talking about this, Carol, shares slumping as much as 16% after they reported weaker than expected first quarter gross margins. They've got elevated inventory levels. They've got costs related with restructurings, but our analysts do say that they're going to see a correction on that throughout the year. And then I've got to go back to tech here. Airbnb having some issues today, falling as much as 6% earlier today with a report detailing issues with the company, including that it's increasingly reliant on professionally managed properties that are also competitors. Pairing those declines a little bit, though, after Bernstein refuted that report. But I also have to wonder if the Airbnb story is just the tech sell-off that we've been seeing
You go back to the broader market. We were just speaking with David Leibovitz over at JP Morgan Asset Management, making clear how he saw the correlation between what was going on in the equity market and what was going on with yields. A big drop in yields here on the week. In fact, if we look at the sort of the middle of the curve and that 10-year yield, you're basically talking about a 7-day rally right now that's taking that 10-year yield down from a risk around like 3.5%. 0.5%, down to about 3.3%. The differential that we're seeing on the two-year yield also quite remarkable. We did see a yield tick slightly higher on the two-year on the day, but remember, we were above 4% on a closing basis, settlement basis, just last week, a week ago, last Thursday. And remember, on an intraday basis, we were above 4% at one point this week. In fact, this is actually one of the fatter trading ranges that we've seen for the two-year yield, at least I think for the year so far, something like 49 basis points. I'll double check that, but we're now really just talking about something like 20, 23 straight weeks where we've seen this type of relentless rally. Something to keep an eye on, because that really is feeding into the broader concerns here about macro conditions and the equity market.
And guys, obviously 16 hours from now, we're going to be dripped in sweat, obviously, even though we don't have to work for most of us, waiting for those numbers to come out, right?
What are you going to be doing, Fanny?
And obviously waiting for those numbers to come out.
Okay.
But
in your wedgie jeans?
Right, maybe.
Yeah,
Stonewashed.
Levi's.
But there is more coming, right? So we should get too excited. There's a whole week of data next week. We're going to get consumer credit as well tomorrow. And next week we have things like CPI and PPI and all sorts of...
Yeah, I'm actually glad you bring that up, because everyone's so focused on this jobs report. But I mean, you kind of forget about some of the other economic data that we're going to get next week, including, like you said, retail sales, CPI, PPI. But then also, of course, the start of the earnings season. I mean, a lot of these companies are really going to have to lay bare what really went down in Q1.
Yeah, we were talking with our Molly Smith of our economics team here at Bloomberg earlier, and I'm like, yeah, I'm looking forward to, the earnings story. And she's like, hey, I'm looking forward to CPI and what it says, because I think every data point is really important, and it certainly is to the Fed, and every data point that gets them closer to the next Fed meeting will ultimately determine what they do in terms of monetary policy.
Well, we've been accusing the Fed, or our sources have been accusing the Fed of being a little bit too data dependent. So every single piece of data is absolutely critical, and tomorrow's jobs report is the last one we get before the next FOMC meeting, making it all the more critical.
Well, and of course, that warning from the IMF has to have sent a chill through all sorts of policymakers as well as us, obviously. And the idea that the dollar index is very dependent on things like jobs and so on. And that's going to have an impact on outside economies, which will have a feedback loop on our economy and other economies. There's so much going on, and there's so many things that crisscross and tag each other at the moment that it's almost hard to keep track of.
And let's keep in mind, I mean, you talk about that next Fed meeting on where the decision, I think it's on May 3rd. But the idea here that how many things could happen between now and then, nobody really obviously predicted what would happen with SVB, Signature Bank, et cetera, et cetera. That's something the Fed has to factor in. OPEC Plus, of course, surprised last Sunday. That has to be factored in. So, I mean, who knows what can happen? I mean, that's 4 weeks away, Madeline.
Well, can I just, what you said earlier.
Carol, why don't you talk for Maddie? Go ahead.
Please, by all means.
Stop. No, but what's interesting is think about what has changed dramatically in terms of rates, that 2-year, right, or even the 10-year, but the 2-year in terms of 3 weeks. So if we get some different data sets, could we go back above 4%? I think it's a good point. We just don't know exactly what's going to happen.
I was crunching the data. I just wanted to make sure I got this right.
Maddie would have said that much better than I would have.
On a daily basis.
That was perfect.
What? Go.
On a daily basis, the 2-year yield has swung at least 10 basis points or more for 23 straight sessions.
And that's with a...
This is the sovereign debt of the United States of America, the world's largest economy, presumably the world's safest debt instrument out there.
Right.
23 straight sessions.
And in amounts not seen since the financial crisis. We're talking $1.2 trillion a day being traded here.
Yeah.
And what is the bond market seeing that the equities market is choosing not to see, and that the Fed is also not seeing, right?
Yeah. Well, I think, can I say it? Recession. I mean, I'm not calling it, but I'm just saying that when you look at those moves in yield, and more importantly, the steepening of the yield curve, at least on a historical basis, that's typically what that means.
Jim Bullard doesn't think we're going to tip into a recession.
Is he speaking again today?
He did.
Tomorrow?
But then we had Jamie Dimon earlier this afternoon saying he's thinking recession.
But Bullard says he doesn't think the tighter credit conditions.
I'm going to wait for his next.
Is that what's priced into the equity markets? I mean,
Happy Easter egg hunting, if that's the thing you do. Okay, everybody? All right. Of course, we'll get the jobs report.
I'll see you on
tomorrow morning.
Monday,
Bloomberg will be on it. I will see you on Monday. Have a good long weekend for those who are taking a long weekend. That's a wrap for our cross-platform coverage. Beyond the Bell, radio, TV, YouTube, and Bloomberg Originals. We will see you again, this team, same time, same place on Monday. an eye on shares of Apple, way outperforming this year, both the NASDAQ 100 and the S&P 500, up roughly almost 30% year to date. And among the things the company is definitely known for is something we talked about yesterday, the global supply chain. We talked about it with our Bloomberg Business Week team, Joel Weber. And a really smart story by our Mark Gurman, in terms of how they manage it. But another really smart thing at the company is their cash-rich balance sheet. They got tons of money on that balance sheet.
They are, what an incredible problem to have, right, Carol? Don't you wish?
It's always remarkable. I always feel like when it comes to Apple, it's the law of large numbers.
Yeah.
Let's get to it, though. Bloomberg News equities reporter Ryan Vlastelica is writing about the cash sheet of Apple. He is on the phone in Chicago, and also with us is Bloomberg News technology reporter Mark Gurman. He's out there in our LA bureau. Mark, as we mentioned earlier, that must-read story on how Apple's looking beyond China in a bid to remake its global supply chains. It's in the new issue of Bloomberg Business Week, out on newsstands, online, and on Bloomberg. We'll dig into that in a moment as well. But Ryan, I do want to start with you. Your story gets into that enviable Apple balance sheet, massive balance sheet, and what they could do with it. Tell us about your thinking here.
Yeah, absolutely. So they have so much cash on hand that they could, if they wanted to, buy almost any company you can think of just by writing a check. However, Apple is a little bit different than some of the other big tech names out there in the sense that it does not do much by way of acquisitions. Of course, you have Microsoft in the middle of its attempt to buy Activision. You have Amazon, which recently bought MGM Studios and is trying to buy iRobot and One Health. So other companies are very aggressive on this front, but Apple is not. And so far, it seems like investors are pretty happy with this. They're pretty content to have the company continue to buy back a ton of money as far as stock repurchases, and they would happily take a little bit of a higher dividend, but at the moment they're happy to have those kinds of uses for cash as opposed to a big acquisition.
Well, one of the stats from your stories shows that Apple spent $306 million on acquisitions in 2022, down from $1.5 billion in 2020. So that just seems like a massive drop off there. Mark, bringing you into the conversation here, you are just the foremost Apple expert, if I can say that. Apple doesn't do big splashy deals, right?
Yeah, they don't do big splashy deals. There's been a lot of talk from shareholders, activists, what have you, of other companies, of a potential takeover of companies like there was discussion about Peloton. There was discussion around Disney. There was discussion about Sonos at one time. There's been discussions of many of the major studios. There was discussion of MGM, right, a year or two ago, right? You name it, people thought Apple was looking at it. Another one, some of the car companies, right? McLaren, right? That's one that cropped up over the years. But Apple's simply not going to do that. They feel like they could use their cash to build competitors, right? Or to build rivals that are just as good as what they would acquire using less money, right? So maybe it would cost them, I don't know, $200 billion to buy a Tesla, right? This is way back before the stock increase, right? Maybe they feel like they can build a better car for 10% of that cost. In terms of TV Plus, maybe they feel like they could spend $20 billion building a competitor to Disney versus spending 5x that or 10x that on buying Disney itself.
All right, so Ryan, as Mark says, we know Apple, and as you pointed out, not known for doing big splashy deals. They are known, though, for returning money, Ryan, to shareholders.
Yes, that's right. They're a huge percentage of overall S&P 500 buybacks, and this coming earnings report is when they will give their update for what they're going to be doing this coming year. So that's something to be mindful of. It's probably going to be a bundle, though.
Yeah, that's really interesting.
Well, and Mark, come back in because, Maddie and I sat down with Joel Weber, the editor of Bloomberg Business Week, along with the tech editor, and we talked a lot about your story, incredible story in the magazine about Apple and its, looking beyond China and remaking that incredibly successful and massive global supply chain that was the genius of Tim Cook, now, of course, the CEO. In terms of thinking about what Apple does with its money, is that what it's about? Like focusing its efforts, its time, its people, and its potentially money on having maybe another supply chain?
Diversification, upgrading its supply chains, those are costly things, right? What they're really focused on is duplicating those efforts that they've built up in China over the past 2-3 decades and really replicating that in parts of India, Malaysia, even some Thailand. Vietnam is a big one. Ireland, a little bit more in Brazil as well. right? And so that's expensive and it's extraordinarily resource intensive. I mean, I think you can see India maybe producing a quarter of iPhones, maybe 50 million or a little bit more than that, iPhone units per year within 2 to 5 years. That's going to be very significant. I think you're going to see Vietnam become the main producer of Macs, right? Laptops and desktops within maybe 5 years or so. They're already taking on a big share of production for AirPods, right? Which obviously in terms of units, that sells more than Macs, yeah, not revenue-wise, of course, but units-wise, you're gonna see more Mac production happening in Ireland as well, right? Ireland, they're ramping up to make more iMacs. That's their all-in-one desktop. You're gonna see more Mac production, sort of the Mac Minis and the Mac Studios happening in Malaysia. You might see more of that in Thailand as well. The big country that I'm not mentioning it, as you may have heard of, is the U.S., right? I don't think you're going to see much happening there to answer questions that a lot of people have been asking.
Because it's too expensive, and our workworkce maybe not as skilled. I hate to say that, but
it's a combination of both. I mean, like everything they've tried to do in the U.S. production-wise, I hate to use the word disaster, but it's been, if you're taking the context of what a disaster is and you're talking simply within the idea of computer and technology production, it was a disaster, right? On the scale of everything going on in the world, it's not a disaster, but in terms of that, very small part of the globe, that it was a disaster.
Okay, so Ryan, come back in here. Given everything that Mark is saying about the amount of money Apple would have to spend to build up this infrastructure for production outside of China, what have your sources told you about how concerned they would be if Apple pivoted and said, actually, we're going to acquire Disney while we also build up this manufacturing?
Well, doing something like buying Disney would be so out of character for them, and it would be so expensive and just so not aligned with their traditional businesses that I think people would just be like, what would be behind such a massive strategy shift like this? It would just be so unexpected that I think people would be concerned and worried about why they feel like this is necessary. It would be a pretty high bar to convince investors that they would be able to justify a deal like this as far as what it would mean for their growth and overall business efficiency.
Yeah, no, it's pretty amazing when we think about the potential, but probably not the likelihood. Hey, Mark, just got about 40 seconds left here. I do feel like Apple is such a barometer for so much when it comes to just the global economy, global business. This pivot that it seems to increasingly be doing and have to be very careful in how it does it so it doesn't alienate China. This is like the mark of an era, if you will.
It's the beginning of a new era for Apple. I mean, right now, most Apple products say assembled in China on the back. You name any country in Southeast Asia could soon say that on the back. I mean, I was on a plane yesterday. I was holding my AirPods, and then I had my fiance's AirPods in my other hand, just comparing them. Mine said China, hers said Vietnam. So this is already underway. And you're going to see a lot more of that in the future.
That's really good anecdotal evidence, Mark Gurman. That's good stuff.
That is fascinating. Yeah, it's changing. I always remember like ordering something on Apple and just you could follow it in terms of the supply chain of like where it is, and it always kind of blew our mind. Guys, thank you so much. Mark Gurman, technology reporter at Bloomberg News, his new story in the new issue of Bloomberg Business Week, and Ryan Vlastelica, equities reporter at Bloomberg News. Both their stories find at Bloomberg.com and on the Bloomberg terminal. This is Bloomberg Business Week.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. With hours to go ahead of the jobs report, turned out to be an up day today for the Dow, the S&P, and NASDAQ. The Dow eking out a 2-point gain, up less than 0.1%. Wall Street, though, remains unwilling to commit to significant positioning ahead of tomorrow morning's job report. Stocks had gains, bonds were trading mixed, and the dollar barely budged. Bloomberg Radio and Television will have live coverage of tomorrow morning's jobs report in a special edition of Bloomberg Surveillance beginning at 7 a.m. Wall Street time. The S&P was up 14 points, finishing a holiday-shortened trading week at 4105, up by about 0.4%. NASDAQ up 91. That was a gain of about 0.8%. 10-year yield 3.30%, with the 2-year 3.83%. Spot gold down $13 the ounce to 2007, down 0.7%. And West Texas Intermediate crude down 0.2% to $80.43 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Thursday. Carol Masser, along with Quick Takes Madison Mills, and of course on YouTube and Bloomberg Originals. So remember yesterday, and you reminded us this, Maddie, in our planning call this morning, that study about Americans spending less time working than they did before the pandemic.
Yeah, and one reason why, of course, is the coronavirus itself, either because of the fear of catching it or because of long COVID, and that is the debilitating long-term effect on some who've been infected with the coronavirus. So here back with us with an update on the impacts of long COVID is Priya Dugal, epidemiologist, at the Johns Hopkins Bloomberg School of Public Health, which I should mention is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Priya is co-lead of the Johns Hopkins COVID Law Study and joins us on Zoom from Baltimore. Priya, great to speak with you, and thanks for coming on to talk about this because it's so important. Talk to me about the news that you have when it comes to long COVID and just how many people are impacted by it. What's the scale look like?
Yeah, thanks so much for having me. Well, there's no doubt that people have been affected by COVID, both the acute form, right, getting sick initially, and then this long-term form. It looks like about 30% of people report long-term symptoms. That means that they're having symptoms 12 weeks or 3 months post their initial infection. But the good news is that we're starting to see that that number is starting to decrease in some individuals. So it's of those currently saying they're experiencing long COVID symptoms, it's closer to about 10 to 15%, which could be due to things like vaccines or having had a previous infection or the differences in the variants. So that's 10 to 15% of people who have had COVID are reporting long COVID symptoms currently.
That's comforting. I think I even had a little bit of long COVID, just feeling almost very, very tired for at least 3 months and just wondering, okay, what's going on? So it's interesting to hear you say how those numbers are getting better, actually really comforting and smart. Is it just the body kind of working its way through it, Priya? Is that what it's all about, or is it treatments that we're doing to help individuals with long COVID symptoms get through it?
Yeah, that's really hard to say. So the problem is that there's so many varied symptoms. There are really literally, 20 to 30 different symptoms that people are saying that they're experiencing, each individual. And so for some of them, there are treatments that are available, sort of standard treatments you'd give for someone with that symptom. And for others, like fatigue that you mentioned, there really isn't something that we can treat you with. So some of it is about people just getting better over time. And of course, some of it is about some individuals just not responding well. And we don't really understand the mechanism of what's happening with long COVID, how it affects different organs. We do know, and this is the more worrisome part, that somewhere between maybe 1% and 3% of individuals who've had COVID are experiencing really debilitating symptoms. So they're not recovering. And that's the part I think that's going to most greatly affect the workforce.
What do those symptoms look like?
Yeah, so these are people that when we ask them things like, can you walk a quarter of a mile? They say they can't do it, or they do it with a lot of difficulty. Or can you walk up one flight of stairs? That's 10 steps. Can you do it? No, they can't do it. Or they have things like brain fog, or their cognition is decreased. And this is not going away. So they have it 3 months out, and they seem to continue to have it over time.
What's the most common long COVID symptom?
Yeah, so shortness of breath is a really common symptom, as is fatigue. And then people have heart palpitations or tachycardia, so their heart starts to race tremendously. And then some people are reporting, excessive amounts of joint and muscle pains that continue over time.
Yeah, I have a friend who was an amazing gymnast, really healthy prior to COVID, got COVID really early on, and still has not been able to get back to running as much as she was prior to getting infected. Priya, do we know anything else about who is most susceptible to long COVID? Like the example with my friend has always blown my mind because she's so healthy.
Yeah, that's the part that I think scares all of us just a little bit more, right? Which is that it seems to affect all ages, especially among adults. Children seem to present differently. And so it's not just individuals who are older that are actually having these effects, or people who had predisposing conditions. This is affecting healthy people as well. And it's a bit unpredictable who that's going to be. We do see in our reports that women seem to be reporting more symptoms than men, but men also report these symptoms. And it affects all races, different, standards of living. It affects pretty much anyone could be a person that has this. We do know that if you've been vaccinated, it seems to have been, you're more protected against having it. And that may also explain why we're seeing this decrease, because early on vaccine wasn't available. But as people are getting vaccinated and boosted, it seems to protect you from getting some of these long COVID symptoms.
Hey, I'm going to do a little bit of a tangent here, but are we supposed to plan on getting a COVID vaccine every year, just like a flu vaccine? I was thinking about, I've got 5 in me, plus a flu vaccine, have had COVID twice. I'm just curious, though, will that be what is to come? Do you know? I know you guys talk about this and work on this kind of stuff. I'm just curious.
Yeah, it's so I'm not an expert on what.
No, and forgive me.
That's okay. I'm not an expert on the vaccine side, but I can tell you that the overall assessment is we need to understand a couple of things, which is if the virus mutates again the way it has multiple times, then getting protected by a booster of some sort is going to be really critical. What we do know right now is for individuals who are younger and healthier, there hasn't been a larger push to get another booster, but they are in talks right now to push a booster for people who are older or who have specific health risks. And so that booster, every 6 months or possibly every year may be more targeted to certain individuals. Or it could be that we tell everyone, once a year, just like the flu, you get this and you'll be somewhat protected for the year.
All right. Speaking of protection, we were talking about, folks who get long COVID. Priya, what are we hearing about in terms of how the government thinks about disability for those individuals with long COVID?
Yeah, so we're really fortunate that early on the government declared long COVID a disability. And so individuals who are suffering from these conditions can apply for disability overall, which I think is important because, as we mentioned, it is going to affect the workforce. But I also think that the part that we're not fully, understanding is all of these people that are having symptoms, and that includes both the mental health issues as well as the physical health issues related to the virus. Or is there something else that's going on in our workforce right now where people are less likely to be working?
Hey, I wonder too, Priya, if you can talk a little bit about the end of the COVID-19 national emergency in the United States. President Biden, I believe, has already set the end date at May 11th, or he's about to in the coming days. Correct me on that if you know. But I wonder to what extent the undoing of COVID as a national emergency at the federal level impacts any sort of disability care or government assistance that patients might be able to get.
Yeah, I think that the concern is just in general, the care and assistance that you could get during the pandemic is going to be going away. And that includes just, being able to provide food to people as well who are underserved. So I think we worry about that in general. And we worry about the fact that there just aren't a lot of healthcare providers that are going to be able to easily get to the amount of patients we're seeing who have long COVID. So it's not that the percent is overwhelming. When I tell you 1 to 3% of our workforce, that's not shocking. But when you think of the fact that there are so many people that have had COVID, that's a really, really large number. And that number in terms of getting them care, getting them diagnosed, we need more resources for it. So it'll be interesting to see if resources are reallocated to help individuals who are suffering with long COVID.
Hey, Priya, last question. Some of the work you do, an epidemiologist, you look at adaptive immunity and immunity in general. The pandemic certainly, kicked us all off our feet in realizing we aren't immune to some really serious stuff that's out there. Having said that, how is our immunity changing as bodies, as individuals?
Yeah, so our immunity is always adapting to everything that we see around us, which is what's so amazing. And so now that we are all back out there and people are interacting, you'll continue to see that some people are getting sicker or not sicker because they're exposed to some of the viruses and bacteria that we would have seen before. All that's a positive for our immune system in general, but there is always the unknown of what's coming, just like with SARS-CoV-2, things we haven't seen before and our ability to react to it. So we hope we don't see those, but we never know.
Yeah, you're right. I had a flu like for the first time in I can't even remember how many years, and I'm still wearing masks like on the subway, but it was a pretty nasty flu. And then, you know, it was a reminder like, here it comes.
You never know what other
stuff.
infectious disease is around the corner too. Priya, we'll have to have you come back to talk to us about what else you're worried about beyond long COVID, but there's just so much going on.
There's so much stuff. Priya, thank you so much. Have a great weekend. Priya Dougal, she's epidemiologist at Johns Hopkins Bloomberg School of Public Health. As you know, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropy. She too, as we mentioned earlier, co-lead of the Johns Hopkins COVID long study, giving us an update on that study, joining us via Zoom from Baltimore. Hey, coming up, the pandemic reminding us we are living in very unusual times. The bank collapses also reminding us of that. We're going to talk specifically about how to live in this wacky world. That's coming up next. Right now, though, let's get a check on world and national news. Nancy Lyons covering it all in our 99.1 newsroom in Washington. Hey, Nance.
Thanks, Carol. An after-action report has been completed on the U.S. withdrawal from Afghanistan. The White House acknowledges better planning would have helped. National Security Council spokesman John Kirby says the president was right to leave, but had to proceed under conditions that were set by the Trump administration.
While it was always the president's intent to end that war, it is also undeniable that decisions made and the lack of planning done by the previous administration significantly limited options available to him.
Kirby says the U.S. did not anticipate that Afghanistan's defense forces would not fight for their country. 3 state lawmakers in Tennessee are pushing back on state gun legislation that they say does not go far enough, and they could be expelled today for their demonstrations on the floor last week following the school shooting in Nashville. Representative Justin Jones defended the protest in his floor speech ahead of today's vote.
A state in which the Ku Klux Klan was founded is now attempting another power grab by silencing the 2 youngest black representatives and one of the only women, Democratic women in this body. That's what this is about.
Republican Representative Gino Bolso says the lawmakers violated House rules.
He and 2 other representatives effectively conducted a mutiny on March the 30th of 2023 in this very chamber.
The upcoming vote on whether to oust Representatives Justin Jones, Gloria Johnson, and Justin Pearson would be an extraordinary move. The chamber has used it only a handful of times since the Civil War. The Masters tournament underway in Augusta. John Rahm is caught up to Victor Hovland. They are both in the lead at 7 under. Both are in the clubhouse. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with headlines from the Bloomberg Professional Service. Fed discount window loans fell to $69.7 billion from $88.2 billion a week ago, and Fed bank term funding loans rose to $79 billion from $64.4 billion 1 week ago. Turned out to be an up day for the Dow, the S&P, and NASDAQ. The Dow spent most of the session swinging between gains and losses. It eked out a 2-point gain, up less than 0.1%. S&P up 14, a gain of 0.4%. NASDAQ up 91, higher by 0.8%. So an up day for the Dow, the S&P, and NASDAQ ahead of tomorrow morning's jobs report. Bloomberg Radio and Television will have live coverage of that jobs report in a special edition of Bloomberg Surveillance beginning at 7 a.m. Wall Street time. 10-year yield 3.30%, with the 2-year 3.82%. Spot gold down $13 the ounce to 2007, while West Texas Intermediate crude today was down by 0.2%, 80.48 a barrel. As investors dissect the latest data, Jennifer Lee of BMO Nesbitt says the focus will remain on inflation.
We're taking each component and slicing it even further down into the bone, and to making sure that that inflation trends are slowing. And until we see that happening, I don't think the Fed's going to be easing up anytime soon.
Walmart plans to add thousands of electric vehicle charging stations by 2030, saying the move will make it easier for motorists to pivot away from cars powered by fossil fuels. Walmart today up by 0.7%. Costco wholesale slipped as a second straight slowdown in a key monthly sales gauge, stoked doubts about the strength of U.S. consumers. Today, Costco was down 2.2%. Recapping an up day for the S&P, higher by 14 points today, up by 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, so appreciate it. Charlie Pellet there. Well, you are listening and watching Bloomberg Business Week on YouTube, on Bloomberg Originals, and of course in our Interactive Brokers studio. Carol Massar along with Maddie Mills. So inflation, bank collapses, mortgage rates shooting up, car prices, don't even ask, layoffs, add it all up, and yeah, we are all pretty fearful about checking out our 401ks. So what do you do with your money, your life, in our brave new and wild world? So let's get into it, because there's this great story in the new issue of Bloomberg Business Week. It is out on newsstands, the new issue on the Bloomberg and at Bloomberg.com/businessweek. Joining us right now is Bloomberg Business Week Markets and Finance Editor Pat Regnier here in our Bloomberg Interactive Brokers studio. Pat, I said to you before we get going, these are the kind of stories I always expect Business Week to do, and you do it so well. It's like the practical information, taking the macro issues and kind of what do we need to do. Tell us about this story.
Yeah, so the genesis of this story was my colleague Brett Began was talking to me about just sort of like, we were just talking across the row about all of the financial concerns that were coming up in his mind, and it felt like a lot has changed in finance after kind of a long period of everything being the same for a really long time.
It's true.
And then we had kind of the pandemic emergency, and so we were mostly just kind of covering the emergency, and it felt like any advice you would give would be incredibly temporary. And now all of a sudden it's like we've had this kind of shift. And a lot of things are changing, and people's financial lives are very complicated. And honestly, the way that we put this together was we started, Brett and I and Craig Giamona, who heads our personal finance coverage, and most importantly, the writer Claire Ballantine. We all just sat together and said, look, what are the things that we're all worried about? So it's got a mix of things on like what should you do with your investing, to something that I have to be thinking about all the time, which is how do I think about the cost of college for your kids, to buying a car. Is this a good time to buy a house? All the answers are really
expensive right now.
Yeah, basically part of the answer is everything's expensive, and kind of frustratingly, including like stocks.
Yeah, well, that's another good thing that you get into in valuations. It's something we talk about, in our simulcast and constantly, like trying to understand, is the market fairly valued or is it overvalued at this point?
Yeah, so this is kind of tricky. We've had we're all trying to buy the dip, right? And 2022 was a dip. And so you want to know is like, well, so now is like everything like kind of an incredible bargain, and you know, as Claire found by looking at the numbers very quickly, it's almost any metric you look at, it's like, well, everything's definitely cheaper than it was in 2021. But if you sort of like you zoom out the chart, and you look at price sales, price book. My personal favorite metric is I like to look at like the earnings yield, because it's just like a really straightforward like read on like what do you get for your money when you buy a stock. Cheaper than it was, not historically cheap. You know, and what does that tell you? Well, you know, a lot of people who are listening to Bloomberg use the terminal. They're making decisions about tomorrow, a week, a little while along. This story is very much kind of a kitchen table kind of story. I think mostly the answer is you're not going to get this timing right.
These are the questions when I get together with family or relatives or good friends. Like, this is the kind of questions that come up.
And that they ask you, right? They're like, hey, you work at Bloomberg. Can you tell me whether or not I should get an Amex? You're like, I mean, I don't cover that.
What are Fed funds futures doing? It's right. Should we get that new Amex? You guys get into that as well.
Yeah, you know, and that's, I am not a points guy. There are people I know who are like constantly like maximizing their points and things like that. Maybe they travel more than me.
Have you met Charlie Pellet here, who's probably listening?
Oh, is he good with points?
Oh my God! With
I gotta get his
travel
advice.
awards and credit cards. But I digress.
I took a flight to Dubai, and all of a sudden I started thinking about points. It's like, gosh, there's points here, aren't there?
Yes.
Yeah. So Amex has a card that has like an annual fee of like $700, and like, you know, it's got a lot of rewards, and it looks like, you know, in your first year, probably the points you get might justify that cost, but you want to think ahead to like, you know, is that going to make sense over the long run? And the answer is kind of like, are you a points guy? Are you a points gal? You know, if you're somebody who thinks about it, maybe you can kind of squeeze those rewards out.
Yeah.
I don't like to have that brain space in my life.
Yeah.
No, it's kind of annoying. It's
yeah,
kind of
so you should
crazy.
know that about yourself, I think, before you kind of sign up for the fancy new car.
Well, you bring up Dubai, which is the place to move if you want to pay zero taxes, because that's what happens if you move there, literally no taxes. One of the things that you cover in the story, though, is which state in the U.S. you could move to potentially get a little bit of a discount on taxes.
Yeah, so I mean, we've certainly heard this story. I mean, particularly with the pandemic, that people are thinking about moving to Florida, moving to Texas. People are moving to Florida, are moving to Texas. I mean, the problem with that is always like, well, you know, if you're having this bright idea, guess what? People have been having this bright idea for about 5 years, and anybody who lives in Austin can tell you that, you know, the Austin housing market wasn't really ready for all the people who came there.
Right.
So, you know, if you look at sort of like local salaries and like what does it take based on what people make, you know, to save up for a down payment on a house in Austin, guess what? It's just like living in New York City.
I have to say, I was just having this conversation with somebody who's starting to actually think about like retirement and stuff, and just thinking, okay, what are the markets I should go to? And I was telling them a story, an anecdotal story of some family members who went somewhere, cheap market, but in the last 3-4 years, the housing prices have just shot up. This is like in the Carolinas. It's just off the charts.
Yeah, and it's tough, and particularly like if you're thinking about retirement. I mean, my wife and I are, you know, thinking about buying a house, and you know, as a friend of ours called it, well, will this be your forever home? And we sort of think it will be, but guess what? We're looking at the market, and it's like, well, the market's still pretty expensive, and on top of that, now, you know, rates went up. So it's like, is this going to make sense? Are we going to be, you know, finally buying in, you know, both at the top and at a high rate, and did we miss our shot? And that's always just a really, like, that's like a really tough dilemma that I think a lot of people are facing right now.
Well, and it's funny that you say that, because I feel like we constantly say, well, wait a minute, folks, it's not the mortgage rates of the 1970s. It doesn't matter. It still feels really high, and it did go up a lot in the last year or so.
Right, and it's not the mortgage rates of the 1970s, but it's not the home values of the 1970s either.
Yeah.
So
Good point.
the home values were pushed up by the very, very low rates, and now we're getting that shot of high rates. And the houses aren't a liquid market. They haven't just adjusted down magically to make that worth it. They might, but you know, you've got it's a pretty tricky decision, and unfortunately, you can't just type it up on your Bloomberg terminal and see that and watch the price of housing goes down as interest rates go up. The housing market doesn't work that good.
There's a good function to have. We're running out of time, but I will say there's a couple of things that get into I'm thinking of quitting my job for a new one. What should I consider? Can I just leave my job to explore like life, man? Or I'm thinking about freelance. Will my taxes be a nightmare? I think it's just so relevant ahead of the monthly jobs report in a week where we had so much jobs data. But that's going to be a tease, folks, because you're going to have to go online and read it because we're running out of time. Pat Regnier, this was fun. Thank you.
Thank you.
So appreciate it, and great reporting by Claire Ballantyne. Pat Regnier, he is markets and finance reporter at Bloomberg Business Week here in our Interactive Brokers studio. Maddie and I continue. This is Bloomberg Business Week.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. J.P. Morgan CEO Jamie Dimon says the banking crisis has increased the odds of a recession. In an interview with CNN, Dimon added that the banking system is strong, but that the recent turmoil is another weight on the scale in the direction of a recession. J.P. Morgan Chase will be reporting earnings next Friday. Today, the stock fell by about 0.1%. After announcing the largest rounds of layoffs in their history, American big tech companies are now learning how difficult it is to reduce headcount in Europe. Bloomberg's Ed Ludlow is following the story, and he cites France and Amazon as one example of just how thorny the process can be.
Where it gets more complicated is think about how tech companies pay their most tenured staff. Stock compensation and also in bonuses. And what sources are telling us is that in the case of France and Amazon, they're basically allowing people to go on leave basically paid leave to give time enough that those staff can see their stock granted and their bonuses paid. Really financially impactful for those tech companies.
France and Germany have some of the strongest labor laws in the European Union. Amazon shares today up by 1%, did see a tech rally. Alphabet, which also has announced big layoffs, up today by 3.8%. Sources tell Bloomberg Boeing plans to crank up output of its 737 family of jets to a 38-plane monthly rate by the middle of the year. Today, Boeing shares did advance. Boeing today was a little change. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right. Hey, everybody. Carol Master. You know, Tim is on leave, and lucky for us, we have Maddie Mills back from Dubai. You know, I didn't even get to ask you, how was Dubai?
I know. Well, I mean, we came back to Trump's indictment. You know, it was a busy news week for us. So, but it was good.
All right.
It was great.
All right. Well, we'll talk a little bit more about it because I think it's just an incredible experience. All right. Having said that, a lot going on in Dubai, in the U.S., and around the world. So let's get a check on world and national news. Nancy Lyons is on it in D.C. Hey, Nance.
Thanks, Carol. The Republican-controlled Tennessee House has voted to expel one of their colleagues, Representative Justin Jones, who led a protest on the House floor last week urging stiffer gun laws. Jones spoke to his colleagues before the vote was taken.
You have the votes to do what you're going to do today. But I want to let you know that when I came to this well, I was fighting for your children and grandchildren too. That to those who here will cast a vote for expulsion, I was fighting for your children too. To live free from the terror of school shootings and mass shootings.
The vote to expel Jones is an extraordinary move. The chamber has used it only a handful of times since the Civil War. 2 other Democrats could be expelled for their participation in the floor protest. Those votes expected later today. Michael Bloomberg, the founder and majority owner of Bloomberg LP, the parent of Bloomberg Radio, is a donor to groups that support gun control. An interagency review led by the National Security Council on the chaotic withdrawal of U.S. troops from Afghanistan largely lays the blame on former President Trump, saying President Biden was severely constrained by the decision of his predecessor. National Security spokesman John Kirby.
Another lesson learned was the need to plan early and extensively for low probability, high-risk scenarios.
Kirby says President Biden still stands by his decision to leave, saying it was the right one. The Biden administration is set to propose next week the toughest ever U.S. curbs on car pollution, while stopping short of an electric vehicle mandate or a ban on gas-powered models. The regulations are expected to further rein in emissions of carbon dioxide, nitrogen oxide, and other heat-trapping gases from cars and light trucks with the model years 2027 to 2032. The Masters tournament is underway in Augusta. John Rahm and Victor Hovland share the lead at 7 under. They've completed round 1. Tiger Woods is 2 over and tied for 54th. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Maddie.
All right, so appreciate it. Nancy Lyons there in D.C. All right, having said that, what are we going to talk about here?
Well, one thing we could talk about is safety devices that
always important
are very important. An aging, unreliable safety device leaves U.S. airports vulnerable. There's been a surge in close calls, highlighting a need for a system upgrade from the FAA.
This is great for everybody who might be traveling this long
I'm like, we got about a minute and 30 seconds left to tell you guys about the runway safety incident surging.
Yeah, it's a crucial safety system that's relied on to avoid potentially fatal collisions at major U.S. airports. It's aging and plagued by outages that have left travelers unprotected for months at a time. At some airports, it hasn't ever been installed. The technology tracks vehicles on or near runways to alert controllers before impending crashes. Yeah, this is important. Often uses decades-old radar equipment for which spare parts are difficult to find, according to government data and the president of the union representing air traffic controllers, or Alan Levin, writing on this.
Okay, but I feel like the good news here is that if I'm
Silver
understanding this correctly, it's runway incidents, so you're still on the ground in these issues, which makes me feel better. Like, as long as we haven't gotten into the air, I'm feeling better about this.
Kind of our last line of defense, I think, as somebody says. Yeah, no, I understand. You know, we're not up in the air.
We're not like up high, you know?
Yeah. But, you know.
Still not great.
I mean, I'm always amazed at, you know, how much that is secure and safe, but it's